Alphabet Inc. recently kicked off a 6-bar euro debt offering, a move that follows closely on the heels of a nearly $32 billion bond sale just months prior. For a company sitting on mountains of cash, this strategy might seem counterintuitive. Yet these multi-billion-dollar bond deals are a calculated play in the high-stakes world of corporate finance. They reveal a nuanced approach to capital management, even for the most profitable tech giants. The question isn't whether Alphabet needs the money, but why it chooses to borrow it, especially in different currencies and markets. This strategy is about more than just funding operations. It's about optimizing capital structure and hedging against future uncertainties. In the initial phase, Alphabet had already tapped into dollar, sterling, and Swiss franc-denominated notes. This global diversification spreads risk and allows the company to lock in favorable interest rates across different economic zones. The European market offers specific advantages. With the European Central Bank's monetary policies, bond yields can be attractive, allowing companies like Alphabet to secure capital at lower costs than might be available elsewhere. This isn't merely about cheap money. It's also about establishing a presence and liquidity in critical financial markets. By issuing bonds in euros, Alphabet builds relationships with European institutional investors, broadening its investor base. Such large-scale debt offerings can also serve as a strategic hedge against currency fluctuations. If the euro strengthens against other currencies where Alphabet earns revenue, the cost of servicing euro-denominated debt effectively decreases. The timing of these deals is crucial. Companies closely monitor global interest rate environments, anticipating shifts that could make borrowing more expensive in the future. Locking in low rates now is a forward-thinking financial maneuver. For a company like Alphabet, with a market capitalization in the trillions, even a small percentage point difference in interest rates on billions of dollars translates into substantial savings or costs. This strategy also provides operational flexibility. While Alphabet generates immense free cash flow, having accessible debt capital means it can fund large acquisitions, R&D, or infrastructure projects without depleting its cash reserves. So what does this mean for you? Here's what to do with this. First, diversify your own investments across geographies. Just as Alphabet spreads its debt across dollars, euros, and francs, consider international ETFs or global mutual funds to hedge against single market volatility. Second, analyze interest rate trends before making big financial moves. If you're considering a mortgage or a large loan, pay attention to central bank announcements and economic forecasts, as Alphabet does with its bond issuances. Third, understand that even cash-rich entities use debt strategically. For your own business or personal finance, debt isn't inherently bad. It's a tool. Use it to acquire appreciating assets or fund growth, but always with a clear repayment plan. The strongest takeaway here is to view your personal and business finances through the lens of capital structure optimization. Don't just save money. Manage it actively, leveraging available tools like strategic debt to enhance your overall financial position, just as a multi-billion-dollar corporation would.